Welcome back to our channel. My name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center. And today's breaking news, we're going to be talking about the recent passing of Trump's new big, beautiful tax bill. Now, at the time of this recording, the bill has only passed through the House and will have to be voted on by the Senate. But as it stands today, this bill may be well on its way to passing. But the question that we're talking about today on our channel is, how can this bill, if it's actually passed, affect your retirement income? So today we're going to be breaking down the potential good things in this bill and possibly the bad things in this bill as it relates to your retirement income. And we're going to give you some simple things that you should be doing as a retiree to make sure that you're prepared. So let's go ahead and transition over to our teaching slides to talk a little bit more about what the passing of this new Trump tax bill means to you. So now let's go ahead and talk about what's in this bill and what should matter to you as a retiree. Now, first of all, this bill is talking about extending the 2017 Tax Cuts and Jobs Act. So they're talking about extending these tax cuts, which are currently in place today, and are expected to expire at the end of this year in 2025. Also in this bill, Trump is looking at expanding tax relief for the middle class families. Now, this may come in the form of maybe new or expanded child tax credits. We may be talking about possible reduction in payroll taxes here. And we could also be looking at lower tax brackets for middle income households. Also in this bill, what really could be unique for people in the service industry is that Trump will be pushing for zero taxes on tips. He's also looking to keep or expand the higher estate tax exemption, which of course you're going to hear from possibly the Democratic Party as being a tax break for the wealthy. But this is one of the things that Trump is possibly going to continue to try to push for in his new bill. So what's really missing in this bill that should matter to retirees? Well, one of the things that I know is important to my clients that I work with is, what could this new tax bill do to Social Security or Medicare? How's it going to be funded, or how are these two programs going to be able to exist if there's no major changes here? Another area that is missing when it comes to retirement planning in this bill is, how will capital gains or Roth IRAs be treated in the future? And certainly last but not least, what are the long-term implications for our national debt and the entitlement programs that I just mentioned, Social Security and Medicare and Medicaid? How will these things affect retirees? These are the important things that everyone should be wondering about, and how this new bill is going to be able to deal with these sort of outstanding issues for retirees. So when it comes to this bill, let's go ahead and start with the potential positives of what we're looking at here. First of all, one of the positive things about this new big, beautiful tax bill that Trump is calling it, of course, is that lower income tax brackets could be extended. So as I mentioned, Trump wants to extend the 2017 tax cuts and make them permanent, which of course would mean that the lower tax brackets will stay in place and the standard deductions could remain higher as well. Now, this could really affect many retirees. So let's just take a look at a quick example. Let's just say you have a retiree named Jane, and she's retired and she's pulling $40,000 a year from her IRA. Now, if the tax brackets stay low, she may stay in the 12% tax bracket as it currently stands today. But if the tax brackets revert back to what they were before the passing of the 2017 tax cuts, Jane's tax bracket could end up jumping up to 15% or higher in 2026. Therefore, by extending these tax cuts, it could save her hundreds and possibly even thousands of dollars over time. So let's go ahead and move into another potential positive of this tax bill. Now, Trump has mentioned no taxes on tips and has noted that this would be a targeted tax cut for the middle class. So let's go ahead and run through an example of how this particular positive tax break could help a retiree. So let's take a look at this retiree, Mark, who's age 67, and he's decided to take a part-time job as a server at a local restaurant. Let's just say he's earning around $15,000 a year in tips. He also receives $24,000 per year in his Social Security benefits. Now, under the current tax law, what would happen with Mark is that those tips will be fully taxable that he's making. With that being the case, Mark might owe roughly anywhere between 10 to 12% in federal income taxes on these tips. That could equate to around $1,500 to $1,800 in taxes on an annual basis just on his tip income. Now, if the tips were to become tax-free, as Trump is proposing to do with this new bill, Mark would be able to keep an extra $1,500 or more in his pocket. So it would be basically like Mark would be getting an instant pay raise without even working more hours. Another thing to really make note of is that it also means that less of his Social Security income may be taxed as well. So let's look at one more potential positive of this bill. The bigger estate tax exemption may stay the same. Now, of course, this would affect more of the wealthy people in America. The higher estate tax exemption now is currently over $13 million per person. So this bill could make this current estate tax exemption permanent. And so with that being said, I know many people won't fall into this category, but let's just say we do have Karen and Bob who do fall in this category, and they want to pass on their $6 million farm to their kids. Now, if you have a lower estate tax threshold in 2026, this could trigger a high tax bill, maybe 40%, the highest tax rate. But if Trump's new bill keeps these exemptions high, they could pass this estate, their farm, to their kids tax-free. So you can definitely see that if you have an estate $5 million or more, this could be a huge benefit to you. Now, let's go ahead and point out some of the negatives of this bill, and it must be noted for sure. The passing of this bill will no doubt add to our national debt. And of course, when you're adding to the national debt, someone has to pay that bill, and that's going to be paid typically through higher taxes later. Now, it has been clearly noted that extending these tax cuts could add trillions of dollars to our already out of control national debt. With that being said, a future administration may end up raising taxes or maybe cutting benefits to offset this high increase in our national debt. Here's an example of how this can affect you as a retiree. Let's say you have Maria, age 73, maybe age 75, and she has $500,000 in a traditional IRA. If taxes were to go up in 2026 or beyond, her required minimum distributions could be taxed at 25% instead of 15%. Now, we're talking about potentially $5,000 more in taxes that she would have to pay every year. And that would be because the future administrations have decided that they're going to need to raise taxes or maybe even cut benefits in order to somehow pay for these extended tax cuts. Another potential negative is that Medicare and Social Security could face cuts as well. Now, of course, with this bill, if you're extending these tax cuts, that means that you're going to have less tax revenue, which of course has to come from somewhere. And so therefore, they may start looking at entitlement programs like Medicare and Social Security, which they could eventually start cutting or maybe raising the premiums for. Here's an example of how this can affect you. Let's just say that you're 58 years old today and you're planning to retire at age 67. Now, as it has been clearly noted, if Congress does nothing to secure Social Security, your benefits could end up being cut anywhere between 18 to 20%. So let's just say there is a 20% across the board cut when the trust fund actually is potentially scheduled to run out, let's say in 2033 or maybe 2034, and your expected benefits were supposedly going to be $2,000 a month. Well, of course, if you have that 20% across the board haircut, now you're going to be facing a benefit reduction to maybe $1,600 per month instead. And when you start to think about this and calculate this over a possible 20-year retirement, we're talking about a $96,000 loss in potential income just because Social Security had to make cuts in order to pay for the tax revenue that could be potentially lost from this new bill. Let's also consider Medicare. Let's say you're 70 and you're enrolled in traditional Medicare, and your Part B premium right now is $185 per month. But if the government starts to shift more of this program's cost to you as a retiree, you're going to end up bearing the burden of higher premiums and perhaps reduced subsidies or even reduced benefits, and your monthly cost could end up jumping significantly because of that. So what should you be doing as a retiree with the expectation of this bill passing? Well, one of the things you need to do is consider Roth conversions before 2026. You need to try, if you're looking at tax planning, to lock in these lower tax rates now on your traditional IRA dollars. I would also recommend that you always continue to review your tax brackets with your tax preparer every single year. You want to make sure you do this because you want to avoid, if you do any type of withdrawals, getting bumped up into a higher tax bracket unexpectedly. And last but not least, you also want to make sure that you watch out for your Medicare IRMA tax thresholds because they could go up potentially every year too, especially if you're making these withdrawals. They always look back 2 years prior, so you have to be careful here because I can tell you a few $1,000s of extra income could easily raise your premiums to a level that could be very uncomfortable when you're on a fixed income in retirement. So in conclusion, the Trump tax plan could save you money now, but it could definitely cost you more later in your retirement. The retirees who will win in this particular situation is going to be retirees who decide to plan, but not wait or fear the outcome of any new changes.
After this video, please check out our other videos that will give you tips on how to maximize your retirement. And if you like this video, please give it a thumbs up, subscribe to our YouTube channel, and share it with a friend. Thanks for watching, and remember, if you have questions,
we have answers. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today.